Thanks everyone for joining us. So I want to start with Marty and Mark. You've had it easy so far. You guys both have really fascinating histories in the space. I think that's very clear. When you think back to those times at those firms, GSAM, Mark, and Marty in the early days of AHL, what was innovative back then? What really stands out as what you were doing then that just felt innovative then?
It was a great pleasure to hear Christina talk about the dorm room and building everything yourself, because that brought flashbacks from an old man of really the same experience where this was uncharted territory. We had an opportunity of discovering systematic methods. At the time, it was chartism. It was quackery was the London term. Actually, was there anything in this quackery? And it turned out that there was something in this quackery. And then you discovered that we had one contract of cocoa trading alongside one contract of yen. And wasn't it funny that the account tended to make, was more highly correlated with the performance of yen. So then you discovered volatility scaling, which became risk parity. And then you put together a portfolio of strategies and had to figure out how do you calculate the VAR, the risk that you're taking in the portfolio. So it really is an echo of just bootstrapping the whole thing, and that's what it felt like in the early days.
Mark, what comes to mind for you?
Well, I was with a group of former Chicago students who all studied stocks, and we looked at value and small cap and momentum. And what was really innovative to us was that these relatively simple concepts would apply to countries and currencies in the same way they applied to stocks. Mm-hmm. So in 1987, 1997, 1996, those were so unusual concepts that very simple sorts on past return and simple measures of value like price to book generate very high returns, and there wasn't a lot of competition. We used to call that alpha. We don't call that alpha anymore. So that was innovation. And interestingly, we used to, just dating ourselves a little bit, we used to use Excel to bring in the data, and we'd link things, and once a month the data would come in, and we'd all gather around and produce these forecasts and produce trade tickets across 30 accounts, and then stay up all night checking them to make sure they all worked. Yeah. And even though we were a quant firm, it was highly manual, and it was it seemed like incredibly advanced at the time, but it was clearly not from where we look today.
So, clearly it sounds, Mark, like at the time that felt like alpha, right? It felt like kind of, but looking back, Marty, I mean, today, in the context, things like risk parity, these are big products, right? No one would consider those alpha.
No. That's it. That's the arc. But so I think your chart, Rishi, showed, it's analogous to our experience, I think, where over on the left-hand side of the chart, you discover a new application. Momentum, trend following, alpha. Incredibly, in its first instance, it was something diversifying. You couldn't index it. It was, what was your symbol?
The genie with the stars coming out of his hand.
I could do that, and then over time, that's been eroded. So eroded. It's been recast as beta. More people can do it. There's more competition. So to create the new opportunity, you have to work away, find diversifying features from that underlying index.
You have to innovate. So one of the things I love about this panel in particular is just the diversity of businesses and backgrounds that we have up here. And I think it'll give a great set of answers to what we're trying to accomplish. So I want to ask everyone, is alpha, in your experience, harder to find than it used to be?
Oh, yeah. oh, definitely. And not just in high-frequency trading, but I think in many verticals of the alternative assets, alternative management industry in general. If you take a prop shop today, with 5 people, and you put them back in time to 2007, 2008, they would dominate the DRWs and the jumps and the get-goes of the time. Today it's just the competition's gotten a lot more intense, and a lot of the early alpha we see in high-frequency trading has I guess it's just that there's a lot of competition, and so you have to you have to find your niche, you have to find what you're good at, and kind of stick to that. I would say in cryptocurrency, however, it's a completely different story, right? Right now, everyone's on the exploration phase where you can trade whatever you want. You can have the dumbest strategy in the world, and you can still be making 1,000% returns. That's just how it is right now. So yes, it has gone away.
I'll just for the sake of the panel, I'll take a different stance on that, because what is alpha? Alpha is the term that isn't correlated to some underlying index. So when we started doing trend following, we could declare it as alpha, create the index, and suddenly you've got what are we now? An alternative beta for that particular factor. So any alpha that I create is my ability to outperform that beta. So it's a bit like principal. There's no absolute expression of alpha. It's going to be a relative term over time. It's like principal components. So if you're drilling in one particular place, you probably have to keep going out the spectrum of looking for more principal components. But I think also, jumping to a different analogy, in the world of science, do we think we're running out of things that we don't know? And I don't think we are. Back in the 19th century, you could be a polymath. You could know all things. And it's pretty unlikely. Maybe you folks are polymaths, but it's now increasingly specialized to a point. So I would say that there is, just because it feels harder in the industries that we've all been in for a while, I don't think that says in an absolute sense that there is an absence of alpha. There are many assets that you haven't yet discovered, Rishi.
Right. So I would say that for Orthogon, we've traded one problem for another, which is that alpha is actually not hard for us to find. Don't jump and smile when you hear that. It's hard for us to extract. Okay? So there's one thing about when you're in a market, so many things are so convenient. They can be done with the push of a button or the stroke of a pen. With us, we can see alpha. We see it a lot. Outside of markets, all that dark space, we see it a lot. It's just hard to extract. It's hard to bring out. The analogy that I like to use in talks is buried treasure. Okay, so let's suppose you're scuba diving and you find buried treasure, right? Are you rich? Like, most people would stop thinking there, and then the movie's over and the credits roll. But in fact, your problems just start. Gold is very heavy. How do you bring it up? How do you know your crew won't steal the gold? How do you know the country, the little Caribbean island, won't declare the area a maritime park or a national treasure? How do you establish provenance, ownership? How do you bring it back? All of those things are actually what we have traded now to become. So Orthogon is a very operational entity where we basically say, you know what, there's alpha. It's like having tar sands in Canada. There is carbon there, but you know what? I'd rather take oil because it's just too hard to get out. And so we pass on a lot of those alpha generating opportunities because we're not really sure how to extract it.
Maybe I'll just jump in and say that I think terms are a little bit confusing here. I started in academics, and alpha was clear. You had an equilibrium model where you had some factors that were priced. You got a return for them, and it was due to risk. Anything orthogonal to that was alpha. In practice, I think there's a whole spectrum of return sources. On the easiest to access and the most capacity, there's global equity beta. And we all know why you get paid for that. And there's a premium, which time varies depending on supply and demand. Mm-hmm. And on the other extreme is what you're talking about, pure alpha, right? That is completely orthogonal. I would point out that HFT firms are correlated with each other, so it's not like it's completely orthogonal, but nonetheless, we'll call it orthogonal for the moment. And in between, there's a whole bunch of, you might call them alternative risk premium, we like to call them exotic betas, but they're basically different factors, which some are more exotic than others. And it's a competitive equilibrium. Over time, the supply and demand will determine what the return per unit of risk is in all of this. And as more people discover them and decide, oh, they aren't that risky, then maybe they will go into them. And like, for example, last year, everybody's in the short vol trade, right? And vols went to very low levels, and the premium for being short vol was really low. And then we had a little bit of a hiccup on February 5th, and now everyone's buying vol. And so there's a supply demand which has caused the premium for being short vol to go up. So I think that it's not as clean as sort of alpha and beta. It's really a spectrum of return sources, and all of them have supply demand pieces to them.
So Mark, do you think the traditional framework for alpha, the academic one, is somewhat limiting from kind of an organizational perspective, right? In more practical perspective of what alpha actually is day to day?
I think so. I think that investors, ultimately, they want diversified sources of return that they can rely on to deliver a high return per unit of risk, whatever measure of risk they care about. And it doesn't matter whether it's called alpha or exotic beta or alternate risk premium. The question is, can they rely on it? Right? How much confidence do they have that you're going to get a return from it? How correlated is it? Will it be the other things in their portfolio? And so from a business perspective, what I think we provide, and I think probably Marty would say similar things, is that we provide diversified return sources for firms, for investors. They're not equity beta. They can get that for free. We provide other things, and some things are more easily built, and we charge lower fees for those, and some things are more complicated, more capacity constrained, and we charge higher fees for those.
Do you guys feel, in general, that, there's less alpha today? Is that something you feel like? I know competition's high today, but I think there's a difference, right? Is there less alpha available, or does it just require more work, right? Is there always the same amount of winners in markets that there were?
It requires more work. It's not like there's no more opportunities available. So long as there's people who are in the markets participating out there, there's definitely sources of alpha. So long as the economy's going and there's companies up and running, and the companies that are starting from zero that are happening, there's always going to be alpha somewhere out there. It's just a matter of how you can access that. That has changed over time for various industries. So, for instance, in the crypto space, what's interesting is that it's gotten easier. You can literally download an iPhone app, and now you can trade your Bitcoins and your Ethereum and stuff like that from an app. It's so much easier than it used to be. I'm sure because of that, because there's so many people who are into it, and Robinhood, I think I was number 500,000 on the wait list, to even enter this app. I'm sure the competition has kind of driven a lot of the alpha down, in recent times. But at the same time, it has gotten easier in terms of being a lot more democratized than it used to be. And same with high frequency trading as well. I think there was some platforms out there where pretty much anyone. You can be a single mother in Brazil, and you can literally go online and do HFT apparently from some startups. I haven't really tested them or talked to them before, but I've heard about it in the news, and I thought, wow, that's really cool that you can do quant trading, from Hong Kong or from Brazil. You could be a construction worker by day, go home and do this from your home. So I thought that was really fascinating. Yeah, they might not be making billions of dollars anytime soon, but at the same time, they're given the returns and the relative outperformance, maybe they're making enough to feed their family.
So where I'm getting at here is it sounds like competition is really something we need to think about today, maybe more than ever. It's certainly competitive to make money these days in markets, or even probably not in markets. Sourcing trades is hard. But I think there's this narrative of kind of opportunity sets in hedge funds, right? People are invested in a strategy, things don't go so well, and they say, well, the opportunity set's low right now. So do you guys believe opportunity sets are cyclical, or is there kind of a one-way component to the profitability of a strategy?
Can I just jump in and say something, because I haven't said it for the last 3 questions, but every time you ask a question, I mentally add 2 words, in markets, in them. Mm-hmm. There was a fun thing that we used to do when I was a kid, when we ate Chinese food. It was fun to get a fortune in a fortune cookie and then add the 2 words, in bed, to every fortune you got, right? Tomorrow will be your lucky day, in bed. And as you ask questions like, well, is alpha disappearing? I agree with the statements before, speaking to the Renaissance and polymaths. In a zone of the markets, the markets are designed to make it harder and harder and harder until there's some kind of quantum leap. A new product, Bitcoin, may come out, right? And it may be analyzed. That's the surfacing of an asset into a market. But outside the markets, is there more knowledge to be had in general scientific discovery? Of course. Outside of markets, are there more things that can be done? Of course. So it's just a quibble. I'm going to be the quibbler today.
Good.
Do you think sourcing opportunities then, Rishi, is always difficult, or is there some cyclicality to that?
You know, we have no way of mechanizing it, really. If we could mechanize it, it would turn into a business, like venture capital, like private equity, like long-short. Mm-hmm. That being said, no, our real struggle is unlocking. You know, we see a lot of, our definition of alpha is still very academic, which is it's a riskless profit, or i.e., in some state of the world you get a positive payoff, and in no state of the world do you get a negative payoff. But we look at it and we say, I don't want to do that. It's Miller's old definition of elbow grease, right? You get paid for work. And I'm not saying we're lazy, but there are some alpha generative opportunities that are much harder for us. I think I hijacked the question, so I will back off. Okay.
So to remind, yeah, I got questions for you, don't worry. But to remind everyone, so kind of what is your sense of an opportunity set, right? There's some cyclical opportunity implied by those, and I think that's a term we hear a lot. But is there kind of this one-way element of competition? You know, do some strategies just get less profitable?
I don't think they necessarily get less profitable. I think, so first of all, just a little contextual piece that one's attitude to developing systematic trading strategies, you know, it depends what you're in there for. If you're in there to create model soup, my multi-strat, which is the best that I can do, and ideally I would just be trading it with my own money, that's one way to go. Another way to go, which incidentally is what my firm does, and I think what Mark's does, is you try and you serve your clients. This is other people's money. That's worth remembering. And so I think that there's a large element of working with the investor, the asset owner, what it is that they're trying to do with their money, what are the strategies that you're trying to employ. They need some exposure to beta, possibly because of their liabilities. They may need, they may feel more comfortable with a set of strategies that they can articulate what's going on in the cover, and they may or may not feel comfortable with an alpha soup, which is this thing we're talking about, which is the uncertain, adventurous, innovative space. So I think back in the middle tier, the sort of alternative beta space where the investor knows what they're getting, the manager can articulate what it is that they're trying to do there. Yes, it is harder. It's hard, but not impossible to do better in that space. And we have all the opportunities of new technology, new data sources, new techniques that mean it really isn't. It doesn't just come to a dead halt. It's hard, but it's not impossible. And then, you have to have the contract with the client that says, okay, we've mined this one effectively. Will you sponsor us? Will you work with us? Will you support us to go and look in another space?
Yeah, the mathematics of high-frequency trading strategy, that's not a cyclical thing. It's something that will, if you think about statistical arbitrage, if you think about, looking at correlations or co-integrations of certain, products out there, that's going to be around forever. There's always going to be certain products that are correlated with each other. There's always going to be products that are co-integrated with each other or that are uncorrelated with each other. You're always going to be able to model these types of things. The math is always going to be there. It's the implementation of that will change over time depending on how many competitors, there are some things that we traded 5 years ago, and then quickly, after 3 months, we realized, one of our competitors, they know what we're doing, and they're doing the exact same thing as us, and so we're making half the profits that we used to make with that strategy, and so, that's the half-life of the strategy. There are other strategies that we've done for the past 5 years that have still been around for a while, maybe because we're trading something a little bit more niche, that the larger firms, they have bigger fish to kill than over here in our little part of the markets, and so I think it just really depends on what we look at and what we do. But yes, the underlying technology and the math will always kind of continue to be around for some time.
Great. So when you're innovative, right, I think you're necessarily in the minority, right? You have to be, you have competitors, every one of you has competing businesses, you're all competing for assets, you're all investable. So how do you know that you're being innovative, right? How are you thinking about your competition as you shape your individual businesses?
how much of a pay cut people are willing to take to join us. I think that's the short answer of that. For us, like to be able to hire someone who's like, let's say they were the head of HFT at another company, why the heck would they ever quit when they're making hundreds of millions of dollars at their previous company to come join another firm? Well, a lot of it is it's innovation, not just on the trading front of what they get to do and how much contribution they have in the company, but also innovation on the cultural front of how much work-life balance they get, and the type of people they get to work with as well is also kind of a cultural thing. So that's the short answer.
I'm used to working with the actual outputs, like the returns themselves, and looking at the residuals from regressions on factors to understand if there really is something different there or not. And when we started Kepos, we said, look, we kind of know what people do in our space broadly, and they trade either very fast, which I'll use the term HFT, which is probably unfair to you, Christina, because it's slower than you trade much faster than what I have in mind. And then there's also the sort of the quant macro that trades kind of slow and trend following, which is relatively well known. And we said, look, we're going to focus in this time horizon in the middle, which we view as sort of less competitive. And there's less economic literature on that. It's a bit more behavioral, so there's not as much intuition, and we focus in on that. And then we look at the returns of our strategies and look how correlated they are with other factors, and they're not very correlated. So that's how we've approached it. Of course, you got to focus on building things differently from the beginning, but the measures in the result, in the actual returns.
Rishi, what about for you? So, obviously maybe you don't have a ton of competitors directly doing what Orthogon's doing.
We actually don't have any right now.
Which is a good problem to have, but the assets you're competing
That doesn't mean
for,
that's not necessarily a great thing, but
Right.
it just happens to be a fact.
it makes it hard to tell the story, I'm sure, but in some element, you're probably competing for private equity money, or certain parts of institutional portfolios will bucket you, and you will be competing within that bucket.
Oh,
So
okay.
how do you,
Okay,
how
so
do you
let's
kind of
talk
think
about
your
two,
business in that sense?
just not to confuse the topic, let's talk about two zones. We are definitely competing against other very sophisticated managers for investment dollars. We are in competition for that. And our story is very hard to tell. I like to think I'm a clear speaker. It's a very hard to tell story, which is if it's an asset class, if it's anything you can name, we don't want to be a part of it. Because why? Because it has something called a price mechanism, right? And we give up. We just don't want to be part of a price mechanism. We give up. Okay. Downstream, that's not and actually facing the asset, everybody on this stage will also face their great competitors, right? They'll face competition both trying to get the money and in deploying the money into the environments that they deploy into. That's where we don't have competition because by definition we don't have it. Orthogon's about non-competed assets. That's Orthogon in a nutshell. So there, we're very slow, as slow as possible, very methodical, slow as molasses. Don't get it done, hang it up. One of the things we liked is outside of our window of our first office on 54th Street, right across was a guy who was repairing violins. And we can imagine he was making, like Stradivarius, making violins. There was no rush to do it. And we get it done, we get it done. There's no time decay on it. Our mistakes are ones where we pursue something that's just too hard to do. We're not going to build that rocket ship. So that's a relief. But on the even just having half the competition, right? Just the upstream competition for dollars is tough, especially for a startup. And I congratulate especially Christina, who's probably most recent on the scene after us, for having kind of gone past that. Although I understand it never really ends.
Yep.
So Rishi, sticking with you, in your presentation you linked, I think very clearly, alpha and competition.
Yes.
Right? I think you
Competition eliminates alpha.
Totally, very clear. I want you to link
Perfect competition eliminates alpha perfectly.
perfectly.
Right? We teach that to 18-year-olds.
Yeah.
But somehow practitioners sort of lose that idea.
Link for us then again, competition and liquidity. They're definitely two sides of the same coin. And liquidity, for what you do, could be something you have to consider from a risk
We
standpoint.
are maximally illiquid.
Yeah.
Right?
So what
By
does that mean?
definition, if we're doing something nobody else has done before, there's nobody else doing it to sell it to, right? So we're maximally illiquid. There's a price for that.
Yeah. And when you think about yourself and growing your strategy? Does the lack of liquidity create certain limitations in what you can do?
I think the fact that it's illiquid is a necessary precondition to do what we do. If the asset were, right, I'm going to do this little logic trap here. If it were liquid, that means other people are doing it, which means it would be in that alpha vicious cycle, which means we don't want to do it. So we have to do things that other people aren't doing. Things that other people aren't doing are by definition illiquid. That being said, some investors will not want to invest in an illiquid asset. We do not serve that audience, right? Some have more patient capital, and we're not professional fundraisers. I bet you guys can tell this, right? Because I criticize everybody I speak with. So that patient capital wants to earn an illiquidity premium for sure. They deserve it, but they deserve beyond that, right? They can do things that are more experimental. Even your A round would be such an example, right? They weren't investing in stocks. They were investing in Domeyard, right? So that's what I would say.
Sure. But on this topic of liquidity and competition, in the CTA space, to bring things back to kind of the niche here, we've seen this trend of people looking at new markets to apply traditional methods. They're typically a little bit less liquid. They're definitely not futures, and they're called kind of exotics or esoteric strategies. Is this kind of a search for alpha? Is this a search for edge? Is this a search for less competition? What's driving this trend that we're seeing in the managed future space? Marty, why don't we start with you?
Well, we launched last year an alternative markets program, and we are very careful to talk about it, not in the language of it's trading less liquid markets, but we speak about it in terms of it trading harder to access markets. So I think there's an important distinction. So why have we done that? I mean, for two reasons. First of all, the legacy CTA space was very much easy to trade markets, low barriers to entry. From your college dorm room, you can sign up for the feed and you can find a clearing broker. It's plug and play. To be able to trade some of the more esoteric cash instruments and swaps takes infrastructure. They aren't all electronic markets. There is a certain barrier to entry. So first thing is it's applying tried and tested techniques to a new family of markets. And again, consistent with what I said earlier about working with your investors, we haven't just munged it into the same fund and said we're going to keep going with the flagship diversified program and put all good ideas in the same fund. We said for investors that are prepared to take that risk, that they want to put their more beta-ized, more standard, better recognized markets over here, here's something different. So I think it speaks to the quest for innovation. Can you apply the old techniques in new ways to new markets? I should just add that our view is not that these products are successful and have outperformed over the past couple of years the sort of more traditional markets. I don't actually believe that that's intrinsically because they have a higher propensity to trend, if we're talking about trend following. I think that what's interesting about these markets is that you can afford a broader set of diversification. So exactly the motivation to start trading these markets is to have broader diversification, and that's what's been manifest. You just have a broader set of markets which have delivered the kind of diversity in the portfolio that we had back in the 1980s that has somewhat been eroded.
Sure. So if everyone had to comment in looking forward in the future, do you think innovation in the space or in your individual spaces will come from, and Rishi, I think I know your answer on this, will come from new markets or new methods? It replaced markets with assets, Rishi.
I think both, to be honest. There's always going to be new markets out there, new opportunities, new ways to trade, everything, and then there's also going to be new methods and stuff like that too. So I would definitely say both. We'll take advantage of some of the new markets that are coming out and some of the new products that exchanges are releasing and things like that. We definitely are on the lookout. Also in the crypto space, of course, everyone's on the trying to kind of take a look at that these days. So those are the things that, of course, are kind of the newer markets that we're looking at. But then in terms of new opportunities as well, there's going to be new methods. Things are getting faster, things are getting more computerized. So kind of a mix of both.
Mark, what do you think?
I think of our industry as being about economies of scope. And there's 3 dimensions in which we think about scope. One is breadth of assets. One is time dimension of forecasting from HFT to super long horizon. And the third is what information it is that you're using to forecast the markets with. So those 3 dimensions are all 3 things that you can diversify upon, and you should try to do all of the above. But I think that the least dimension that we're going to be able to expand on probably is number of assets. Breadth is just, it is what it is. It's not like we're going to uncover 1,000 new markets tomorrow. Of course, there'll be, China's becoming more accessible. That sort of counts to some degree. But to me, I think Horizon's really interesting, although there's obviously competition at all levels of that. The most interesting area today, though, is information. What information that you're trading on. And the most successful firms have been very innovative in terms of accessing so-called alternative data, newish data that hasn't been discounted at prices. Doesn't mean that once you access it and you're the 12th person that it's going to deliver the same amount of return. You can still make money off world scope, right? It's a much lower return per unit of risk, but there's a lot of potential gain from accessing alternative data. So that to me is like the most interesting dimension to continue to diversify upon and deliver, I'll call it diversified return rather than alpha in the future.
So on the topic of economies of scale and scope, when you look at the tech space, clearly there is a dynamic there where Google and Amazon, they've become these behemoths that can operate at a scale and fund all sorts of ideas and do things at a scale, especially with data, that their competitors can. I think there's huge barriers to entry there. Are the same dynamics developing in hedge funds, right? I looked before this talk, Two Sigma has 1,200 employees these days.
More.
Yeah, more maybe. So is there something that the scale and scope that they are developing, does it afford them opportunities that, are magnified because of these economies of scale and scope? Or does this not exist in hedge funds?
It doesn't exist in hedge funds, and I'll explain why. Basically, Google and Amazon, they do everything under the sun, right? You can buy your groceries from Whole Foods, which is owned by Amazon, your smart home devices, your cell phones, your computers, like everything is owned by Google and Amazon these days. So they, that's how they expanded. They were able to kind of go into different verticals. And then there's like the big behemoths in social media, like Facebook, in America, and then every country has its own, like China has WeChat, Japan there's Line, WhatsApp. Every country has its own app that they use. That's what we call a winner-takes-all industry. Social media where there's only kind of 1 or 2 winners that kind of dominate. Finance is not by design. Finance isn't like that, actually. It's not a winner-takes-all industry. It's designed so that there can be there has to be many players out there competing against one another in order to kind of thrive as an industry. It's also a very top-down industry, so like top-heavy industry. What I mean by that is at a lot of funds, like even at Two Sigma, for instance, the founders, they may be billionaires, but then there's a bunch of people, a lot of the 1,500 or whatever employees, like at the bottom, they're not making nearly as much. And thus you get people who spin out of Two Sigma and do their own thing. That's why you get the Tiger Cubs. They come out of there after a couple of years of experience in that industry, and they realize I can make more money by starting it myself because it's a top-heavy industry. So finance is, I think, by design, designed to be made so that there's many different players out there, including the small guys too.
Mark or Marty, what do you think?
Mark?
Go ahead, Marty.
No, I wouldn't add too much to what Christina said. I think that sort of captured the hopeful sense that it isn't just to the biggest firms. You have to believe that there are opportunities to innovate outside of pure scale. And look at it again, come back to the investor. I know I said I wasn't going to answer this question, but look at it from the investor's point of view. So there's a balance. Once upon a time in the history of one of my firms, we said, well, we think we're pretty good in this particular product area, so we're going to start going into this new product area. And investors' view was, that's not a good idea. We come to you because you're good at this, and we don't want you straying into whatever it was at the time, quant equity or something like that. I think the world has moved into a different place now where investors like a degree of of diversity in the different spectra of areas that you work in, but take that to its logical extreme. And I don't think the investors in this room like the idea of a one-stop shop. You may go to Amazon to do your groceries and order the nanny and whatever. I can't see a world where you go to one institution who does every spectrum of your portfolio construction. That really isn't that healthy.
Sure, and certainly there's a fundamental limitation on size of funds, just given moving a lot of capital through markets. That's a certain limitation. Rishi, when I think about your firm, you're not really constrained by needing to execute a certain amount of trades to return a certain level of risk to your investors. What do you think about in terms of your firm's scale and scope? I mean, obviously you need money to fund operations and things, but is bigger always better for what you're doing?
This is really hard to say because it's difficult to analogize. Financial firms in general are among the worst managed firms on earth, right? Is it safe to say that? And so we're deploying at Orthogon new management paradigms. We have, for example, transparent compensation, where we have a management model that has a flat hierarchy that was developed in Silicon Valley. We're importing those things, and we have to see what is the degree to which that can work. That being said, for us, working is what we do, right? The value proposition, like the buried treasure, is very obvious. Now the question is, do we have enough manpower and know-how to actually do it? It's very workmanlike. It's not comparison shopping, right? It's not like, oh, well, I think it's worth this, but it's actually trading for this, is absolutely not what we do day to day. And so I'll say it's actually mysterious at Orthogon. We definitely could use more people. More people are coming in to basically take apart and build the machines, these origination machines that we talked about before. How many are out there? Can we keep cross-applying knowledge abstractly from one environment? I tried to paint a picture to you where I'm like, okay, well, I'm going to run from charter school capital to Italy to Brazil to Mexico. It's all kind of the same, right? But it's not. You have to be very careful analogizing. You really reason from first principles. And when you go to first principles, you realize they're actually kind of different. It's not great for a speech for me to do it that way, but that's the reality. So we definitely can use more people. And as far as size in terms of AUM, I'll say that's really determined by what we find. It's very odd. In one sense, if you're, I always talk about long-short managers. If you're long-short, you can always take in more money because you can size up your positions. That may erode some of the strategies that you have, et cetera. Those dynamics, everybody in this room understands well. For us, we are not niche. Okay, so niche is like rail cars, aircraft engines, tax liens, music securitizations, drug pharma royalties. We don't do that. We do undiscovered assets, and when you do discover them, they can go into the billions with a B. People, who thought financing charter schools could be financed in the billions. Well, they can be. Our Italian team has financed these receivables in the billions with a B. So I want to be careful about talking about that. These are frontiers that we don't approach at Orthogon. We're very small. And the dynamics as we approach those frontiers could be pretty strange, and I want to be humble about what that might look like.
Mm-hmm. I want to talk about talent. It's something Christina briefly mentioned in her presentation, and I've always been really impressed with the culture that you've been able to curate at Domeyard, especially given your industry and kind of the reputation of that industry in terms of talent and competition. So how do you foster, Christina, like a culture and innovation, on your team?
That's a good question. So one thing that we do, similar to what Rishi does actually, is that we have a flatter structure as well. It's not completely flat. There's no such thing as if there's no managers, if there's no one to make a leadership decision, then you're screwed, right? You have a bunch of people just running around with their heads cut off. You need some direction, you need some leadership, and so we've kind of established this, it's like flat with leaders, where who's the smartest person, who the best researcher is on this product, on this strategy, and who the best people are to go to for these issues. So we really made sure to kind of establish that and nail that down from day one as a culture. And then a couple other things are, one thing that we kind of do a little differently is we're nice to our competitors. We make sure to be nice to everybody out there as much as they're receptive to it. And sometimes they start off being really cold to you, and then they warm up to you, and they're very, very nice. esoterics, CEOs of all the other HFT firms and all the large hedge funds out there as well. So, we welcome them to our office. We show them around. We're not afraid to show them, not even afraid to tell them, the strategies we're working on, because we know that they can't, we built our IP, so they can't just take that, over to where they're working. And so I think doing that also has done a lot for us in that it's helped us hire good talent. So like when Virtu, acquired KCG, this is before that even made the news, actually. We got over 100 applications from KCG engineers and quants, and we were like, wait, what's going on? We had no idea. It wasn't in the news yet. And then a week later, they announced, Virtu's looking to acquire KCG, and we were like, they had let go over half of their employees at the time. And so, where do they go? Well, they go to the companies that were friendly to them, that treated them with respect. And so it was an honor for us that people literally twice my age were applying to come work for me. And so the same thing for us. We're nice as well because of the other reason where if we fail, where do we go as an HFT firm? Well, we'll go to the competitors who were nice to us and who treated us with respect. I don't want to go work for someone who was rude to us when we were a competitor. Like that's not very nice, So that's one thing that definitely we do internally, also cultural-wise, that is really nice. So like I had lunch with CEO of KCG actually, and I mean he left obviously because they were acquired by Virtu, and I think it was a Thursday, and so this was last Thursday actually, and that's our game night, and so we're like, hey, come play Super Smash Bros with our team, and he's like, yeah, sure, why not, and he brought his son along with him, and I think that's the kind of culture that we like, because the team, they feel like, wow, we're really into the industry, and they can hear from all the other leaders out there and kind of learn from them, not just on a video game level, but also on a professional level. So I think that's one thing that we try to instill in the team.
Do you find that you can acquire the same talent at a lower price because of this culture?
To an extent, yeah. Because like we don't want to pay the highest, right? Because that's not a good thing to do. If you pay the highest than everyone else, then you're only attracting people who are attracted to money. And then as soon as someone else out there, maybe a Two Sigma, someone bigger than us, offers a higher price for them, then they're going to just leave right away. You want to establish some sense of loyalty at the company where you're paying them obviously a lot and they're well off, but at the same time it's not that's not the only thing that they're driven by. They need to be driven by the culture. They need to be driven by the people that they're working with as well. So, things like that also matter to the company, yeah.
Sure. Mark, so I mean, you've managed teams of researchers for many years now. What is something that you do or that you think about when you're trying to manage innovation from your researchers, but do it in kind of a responsible and knowledgeable way?
I bring an academic perspective on this problem, which is that knowledge is created primarily when you get interaction between people with different perspectives. So it's important to have diversity on the team. It's important to have people in one place so they can interact. It's important to have flexibility in what you do research in. So we have a laissez-faire approach. If somebody's working in a strategy in, say, equities, and they have ideas on how they could apply those strategies somewhere else, we have completely open flexibility. They can do research in fixed income or whatever. And we encourage people to work together on strategies as well. So I think what we've done, which again is modeled on academics, is diversity, interaction, largely through seminars. You learn, I can think about all of my aha moments in life, not all of them, but many of them. And a lot of them occur during a seminar. Somebody presenting something, you think you know it, right? You probably read the paper. And they start presenting, and somebody asks them a question. Like, oh, I hadn't thought about that question, and sort of that spawns a whole conversation, and they sort of, oh, that's a whole tidbit of a different direction that you could take that idea. So we really try to foster that kind of interaction, kind of open discussion, and allow people to participate in a flexible way in that kind of environment.
Rishi, what does the ideal candidate look like for Orthogon Partners? I mean, given your background.
Right now, we're a startup. And as a startup, it's like being on first base, you need to get to second base.
Yeah.
Right? So I'm going to take your question, like let's assume Orthogon gets past that stage. And we have a very specific culture that is very intense, that makes it very hard for us to hire. And somebody said, well, given that esoterics are all over the place, right? Shouldn't you just be... So we're a high candor culture, a high socially intelligent candor culture. We eliminated hierarchy partly because the ghosts of that kind of system really choke communication no matter what anyone says. And I'm sure that's true at Bridgewater. So that takes a lot. For example, we'll have one-on-ones with, right now we're so small we can have it with every team member each week. And so I will get criticized in a one-on-one 5 times. It's a long day if I do it. Everybody at Orthogon's a partner, right? So speaking to what Christina was saying, people have to come here because they're on a mission. At some point, you have to buy into what we call microeconomics 101, which is if it has a price mechanism, it will eventually, sooner rather than later, get priced efficiently. It's more interesting, back to the invisible hand, in our opinion, to do something that's novel. You'll be rewarded both socially and privately by the invisible hand to do that. That's a hard message to deliver to people who are have worked in very orthodox environments for a long time.
Marty, what does the ideal candidate look for you guys? And you know, it's a little bit different with Aspect, considering you're kind of looking at other businesses and hedge funds to kind of grow the product family at Aspect. What are you looking for maybe in a potential partnership with a hedge fund?
Okay. Well, I think what you allude to is our decision about 4 years ago was to try and broaden the scope of things that we do, of different factors and components and products that we can offer our investors. And we weren't so arrogant as to think we could bootstrap and figure that all out ourselves. And as Mark said, there's huge value in diversity. So we set about a campaign of trying to identify teams that were interested in coming to sit on our platform, and that we felt that they had the track record, the qualifications, and most importantly, the cultural fit. And what has been a journey here is that our original, I shouldn't say this, but in the interest of transparency, our original vision is that we take all of these diverse sets of experience and bring them into the crucible of our research team and seminars, and we get the best possible. There must be one canonically true way of doing trend following, and if we talk to enough people, we'll find it. And actually, that's no longer how I think about this, because I think that the experience that got these folks to where they got to, there are many ways of doing trend following, and then there isn't a single canonical, true, Platonic version of it, and there's value in how they put them together. So what we've tried to do at Aspect is to create the right balance. We've got teams that retain their own intellectual integrity. This is how they do portfolio construction, and the team over here actually has a different worldview of portfolio construction, and I think that's healthy. What we don't do is then put them in separate cubicles and put the food under the door, because and that is some people's valid business model. We're trying to find the real balance where they all go to seminars together, they play nicely, they exchange ideas. One finds an interesting data source, they hand it to another team, but we're not forcing them to that we have to solve this problem. Do we what's the correct calculation of a particular factor? So to answer your question, what's the ideal? I mean, clearly we were looking for particular strategies and expertise where we felt we had holes in the business, and necessary but not sufficient track record, experience, have been through bad times and been able to recover from those. But I think most importantly, it took a very long time to find the people that we now feel very comfortable with. It's culture. It's culture, because finance is such an area that's rife with a spectrum of motivations. That's being very British about it. So the idea of having people that are like-minded and can buy into a business where we respect the individuality, but also the common good of the firm and of our clients is paramount. That took a while to find.
It seems like a little bit of what's driving that decision business-wise at Aspect is that it's a little bit harder for smaller firms to start up these days than it used to. I mean, if you just reference that chart that I pulled up, the number of closures in the hedge fund space, I think, is indicative of the pressure on smaller funds these days. when I look at, again, I keep going back to the world of technology, but there is, clearly a very healthy startup environment there. It's VC funded, and I think it's a great source of new ideas and innovation for that corner of the world. I don't see necessarily those exact dynamics in the hedge fund space. So, I guess, does anyone have thoughts on why it seemed harder for small funds today, no matter their strategy, to start up? And B, what does that mean for new ideas in general for our craft?
Let me just take a first cut. I actually thought it was easy to start up. Now, one of the reasons that occurs is because in some sense Orthogon is in the business of making businesses, right? So if we find an undiscovered asset, we have to mechanize it. It's a fancy way of saying we create a platform around it, which is a business. If you're starting, we have currently operations in 6 countries. If you've learned to start businesses in Brazil, Mexico, Italy, Spain, Portugal, and back at 2 Sigma in other countries still, another half dozen or so. It's pretty easy to do one in the US. Things have changed. I mean, just starting up HR, we started up with Zenefits, which has a whole bunch of salacious stories surrounding it. They have competitors. They're all kind of good. I thought to myself as you were asking your question, well, and you asked before about barriers to entry, how hard it would have been to have taken on someone with an entity with really great data sourcing and technology. Again, I'm speaking outside my professional ken here. But later, a Christina and co. can start up in a dorm room because things democratize. This has negative elements as well, okay? So in the world, and I don't want to release the scope of this conversation, but it would have been very, very hard for an individual to kill a whole bunch of individuals in Toronto the way that happened. But now everything can be weaponized in great power all over the place. So that's a that's a door that swings both ways. That's a knife that cuts both directions. But our issue was actually not starting up. Things are so much more understood, again, in maybe ancillary disciplines, like how to help a manager start up. Mm-hmm. And with the innovation there about where you raised VC capital, that can be imitated, right? There's no patent on that business process. So I wonder about that.
Mm-hmm. Definitely. I think for us, like starting off, when we were trying to hire people, actually, we tried to, first we're like, we need to hire some millennials. We found out actually it was, the reason why the average age of our company's 37 now is actually because we have a hard time hiring the millennials than we do, we have an easier time hiring the I don't know what generations they're called, baby boomers or, whatever. But for the millennials, what's interesting was, so at the beginning, we were like, okay, well, in order to attract the young MIT, Harvard talent, why don't we try to do a Silicon Valley culture, that you had mentioned. And so we tried to do that, and it didn't work, actually. And we had the free food and the whatever else people wanted. Someone wanted an office puppy. Someone wanted video games. Whatever else. That's what those companies.
Should be working there.
My friend, I was just actually in Silicon Valley 2 days ago, and they were talking about how Facebook, they have all the food they have a whole entire campus where all the food is free. Can you imagine? You go walk around, there's all these ice cream shops, and apparently there's this bucket of avocados. And that's it's California. People love avocados, and apparently they say that employees will complain and riot if that avocado bucket goes empty. So that's just how crazy it is. So we tried to do that, and it didn't work. And the reason why is because we realized that people don't stay because of the free food. People don't stay because of the puppy or because of the video games or the cool computers or whatever else, right? Your employees stay at a company because their work is being valued, because their voice is being heard, because they're making leadership decisions at a higher level that impact the company. That's what people like to see, no matter what your age is. And so, we quickly got rid of some of the unnecessary perks, and we keep some of the, so we keep the free food because we realize that people like to talk to each other and hear what's happening on other teams, and it helps with the interaction. You become friends with each other. So we kept that one, but some of the other perks we decided, okay, let's not do the book club. We can get rid of that. Not everyone wants to do the book club. So we kind of figure out different ways to make the culture better, and then just stick with that. And so So yeah, for us, like starting up was incredibly difficult. Raising venture capital is easier said than done. VC firms don't invest in hedge funds, right? If any of you guys work at a VC, you're like, why would I ever invest in a fund? It's still the same way today. The time horizon for a venture capitalist is 5 to 10 years, whereas for a hedge fund, most hedge funds fail within 3 years' time. Like it's just a completely different horizon. And also in terms of returns, you don't know how do you evaluate a hedge fund because we're deploying this hedge fund out here, and then there's a management company here, and so the valuation structure is completely different. We're not selling a product. We don't have a marketing team. It's completely different. And so for us, actually raising VC funding was very difficult starting off. And I'll tell you, like I was subsisting on like ramen, and we were literally living we rented an apartment. We were like trading from the apartment, and like all 3 co-founders were living in the apartment too. Like that's like how cramped things were until they discovered we were in office, and they kicked us out. And then we had to go to a WeWork and actually work out of somewhere else. But anyway, so the first couple of years were very difficult for us, and I don't know if I would want to redo those years ever again. And it's just hilarious because now we're in the best office space in Boston, and people come to our office. They can't believe how amazing we have it, and how beautiful the view and the team and everything is so well put together. But when we started, it was literally in the dorm room before the apartment, it was a dorm room. In the dorm room, we literally took scraps from the MIT, what is it called, the junkyard of MIT. We would grab computer scraps, and they had a server cabinet. We still have that server, little cabinet thingy that we picked from MIT. So we would pick up scraps for free, and that was literally the humblest beginning you could possibly have imagined. And then we kind of just decided to, went from there, basically.
Well, for the sake of time, I want to leave a little bit for questions if we have them. But this last question is unique for us. I don't think we answer these ones, and I don't think we maybe talk about this as much as other industries. But I want you to either talk about your business or your industry or a related industry in finance, and just tell us what you think it'll be like in 5 years, what'll be different, what's the same. And if you really are ambitious, you can go out farther to a decade or farther. We won't write these down. We won't hold you to them. But any thoughts you have on something grandiose like that?
Well, I've been preaching factors for a long time now, and I still think we're like in the second or third inning. Mm-hmm. So where I see the investment industry going is a lot more transparency on factors. Investors should be using tools themselves to measure the factor exposure of their managers so they know what they're getting. And likewise, they should be investing in factors, not in asset classes. And I think that's where we'll head in the next 10 years. There's been movement in that direction already. I think there's more to come. Outside of that, there'll continue to be competition for alpha, for talent, for data, all the things that we've been talking about. I don't know what the world's going to look like. In 10 years, there'll be some other innovation. It may not be technology, it may be something else related to private markets that people are competing for. But I do feel like what we'll definitely see is a proliferation of factor investing as the framework by which investors apply their trade.
Today, when people approach me and they say, I'm starting a financial company, I just automatically assume it must be fintech in one way or another. And related to that note, actually, today, when you want to enter finance, a lot of you guys have kids who are in college right now, and when your college-age kids want to enter the financial industry, you actually don't study finance. You study, math or computer science. That's like the future of where most of the employment is going to be in the financial space. Today, when you look up jobs on a Goldman Sachs website, most of the jobs on that site that are available today require some degree of either mathematical or technical competence in one way or another. That's the industry that's already the future today, basically. But in 5-10 years, it's only gonna amplify.
I actually, in hearing that answer, I realized I never really properly answered your question before, which is the kind of person who's right for Orthogon. And I realize that everybody has some kind of engineering or math background, even though we absolutely don't use math. And what we do, they're just good problem solvers, and they can think abstractly. I would say I'm on record for this in the press that I believe that the enormous salaries and free rents that have accumulated to the financial industry will wane, that there are democratizing elements about, that there's nothing wrong with that, that that's probably even, if anything, a good thing. It's that invisible hand forcing people as economic agents to do more and more interesting and valuable things. In high frequency, of course, famously, there is an arms race and a lot of investment in technology and money that we could really, really debate. And a very smart kid, now he's not a kid anymore, Eric Badish at Chicago has talked about it, you know, how that has occurred. That may continue, but I do believe that the kind of intelligences that were really reserved to the few are now expanding outwards. I think that's a good thing, and we'll have pretty much, I think, seismic changes as even over a course of a decade for this industry, at least the people who are in it, and the winners, I think, will be the investors.
And that's a good segue. I think that we've been living through the past 5-10 years has been a fantastic growth in the, first of all, the systematic investment industry, and at the same time as that, the ability for investors to speak the same language as their managers. It's no longer a case of you can have any color you like as long as it's black. This is what we do, take it or leave it. It's now a discussion. It's, as Mark said, and the taxonomy, the language is a common factor language. So I think that that's been a very important growth in putting power in the hands of the investors. I think the democratization element has helped. You get more for your money in the investing space. And I think that over the course of the next 5 years or so, we're going to see an extension of that arc. But it's a balance. I don't believe, you've had a nice set of questions. I don't think we'll be guided towards 3 behemoth firms which do everything for the pension funds from their beta assets all the way to their alpha assets. You have to have a degree of competition. But I think with all of these elements of barrier to entry, creating flexible platforms, I think you will see some more consolidation. As your charts seem to indicate, there will be some consolidation. But I think this morning has been wonderful that we do know innovation is still alive and well. And the next set of dorm room entrepreneurs, they're coming. They're coming.
We'll open it to questions then.
I'm curious what the panelists, except for Christine, think about cryptocurrencies.
I don't have a view on cryptocurrencies. It means I don't know anything about them.
Can I say something? I'm not necessarily a fan, but I think that we don't know how long Bitcoin's going to be around. China already shut it all down. We don't know how long Ethereum's going to be around. I'm not a crypto bro. I'm actually kind of annoyed when people, put me in that category, in that bucket. But the underlying technology of blockchain, of the kind of decentralized,
Yes.
blockchain, that's going to be around for quite some time. So I think it's important for us, as millennial, founders or whatever, it's important to kind of know that technology. I think it would be a shame for us if we didn't, go about at least understanding what it was. So.
And I think just that, the term cryptocurrencies is so, creates in Britain you talk about the Marmite effect. You either love it or hate it. And I would distinguish, I'm here to learn from the rest of this conference, and the value of the cryptocurrency is technology. So for me, it's the importance of decentralization. I think that is the key thing that I'm interested in about this revolution, this new disruption in the platform, not the currencies themselves. I don't think I'm necessarily in a hurry to start trading that as an alternate source of value as compared with my yen or Brazilian real, but the technology is hugely valuable.
I'll just say, I had to give a talk at the EY Global Alternatives Conference, and the heat on Bitcoin, it was early December, was just palpable in the room. I had to acknowledge it. I held up my cell phone. I said, let's have a guess on what Bitcoin is at. It was the day before, it was at 15,000. People were saying numbers. I said, I'm typing in my cell phone. It's $19,500-ish, and there was a whoosh in the room. Let me tell you about that atmosphere. I talked about a firm that was called BMX Direct, because I think it had to do with bikes, and then it was called like Music Direct. Then they called themselves Bitcoin Direct, and they went up by 200x in market cap just by changing their name sign. Futures were coming out that weekend in Chicago, and I said, you have a futures on an asset that's not really regulated. The stuff you can do with Bitcoin, somebody cornered me by the bathroom. I had to go to the bathroom. Somebody cornered me by the bathroom and said, well, you can do this stuff in Venezuela with Bitcoin. You can't do it with dollars. I said, maybe the US government doesn't want you doing that in Venezuela. And that won't be nice for Bitcoin, so I predicted that there would be increasing regulation. Also that people were saying, well, it's an uncorrelated asset. I said, Bitcoin might be the purest expression of sentiment out there. If it's sentiment, it's not uncorrelated, right? They told me it was a store of value. It's like, I can't even hold it. They said it was a medium of exchange. I said, somebody paid like X hundred Bitcoins for a pizza, has paid 20 million bucks for a pizza. So I think that I'd like to rest on that December 7th prediction because I looked really smart then. But going forward, I would say that regulation is going to be a big deal. To some degree, decentralization is about power. And those who wield power don't necessarily like giving it up. I think that will control the dynamics of cryptocurrencies very broadly going forward, whatever their other merits may be.
Anybody else? Jim.
Christina, I was wondering, are high-frequency trading returns correlated to volatility in the market?
Yeah, to an extent, right? If there's, obviously if there's more volume or more volatility, there's more players out there, then the returns are naturally going to be higher. It does. I think that's the general trend. So if you're a large HFT firm out there, and if the volatility environment's really low, like it was last year, then the performance does suffer, to an extent. But I would say at the same time, the one other thing to keep in mind is that sometimes these HFT firms, they're still making like, 50% or 100% or 200% annualized returns. So it is still, maybe they're making only 45% returns one year, but it's still like relative to, other markets, other industries that, also trade in that same industry. It may look, astronomically high. So yes, to an extent, it is correlated. For us, like we do focus because we're so small, though. There's a little bit less correlation just because we can focus on, we actually do trade some less liquid assets out there as well, and can still, because we're smaller, still maintain the returns that we usually have. So it depends on the company. Yeah.
Anybody else? Cool. Well, thanks, guys. This was a unique panel, and I think you've all been great sports, and really enjoyed it. Thank you so much.
Thank you.